Okay, Ali. So a question we get a lot is very, very good question is, what is it?
We we got it recently on a bunch of things actually, on videos as well as there's been a bit of chatter on the community forum.
Yeah.
Important question, and that is, do CFDs? Well, the gist of everything that I saw was, do CFDs move the market? And I think it's an excellent question that deserves
It
elaboration.
it is indeed. I mean, there's a book that I recommend for anybody trying to explain stuff that's called The Pyramid Principle. And that book basically says that any question or any sentence uttered begs a bunch of questions in the on the side of the receiver. So like I would retort back to that. So for you to understand the answer to that, you first need to understand what a CFD is and what the market is, because there's more than meet the eyes. And in the case of over-the-counter assets,
Yes.
okay. So CFDs and foreign exchange contracts. CFD stands for a contract for differences, which refers to the way that a CFD is settled. So a CFD is, in essence, a bet between two parties. Let's take party A and party B here in the screen. And basically, so Ali is party A and party B. So Ali thinks Vodafone stock is going to go up. And I am party B. In this case, I'm willing to bet or to give Ali the option of placing that bet. So for me to give him that option, I will be on the other side of his trade, right? So let's say the Vodafone stock is trading at 100% right now. I have no idea what the price is of Vodafone stock. I'm not a trader, but you think it's going to go up. So, and I'm willing to be your counterparty for this. So I am willing to bet you that will go down. I will make the spread. That's my business model.
Hmm.
So we can talk about that some other day.
Yeah.
But the important thing, this is a contract for differences because at no time will Ali actually own the Vodafone stock. What's going to happen is the moment that Ali chooses to unwind the bet, we will look at the difference in the delta of the price of what it was, let's say 100. If it's moved to 101%, then I owe Ali 1% increment on the notional of the bet that he just placed with me.
So, am I correct to understand, me being whoever's watching this, that there is no physical exchange of goods,
There is no physical exchange of goods.
that there
There's
is an
no goods.
agreement?
All there is a contract for differences
Hmm.
in which Ali has bet that that the Vodafone stock would go up. And then me in this situation, let's say I am that I would be either a broker or a dealer. So, and this is relevant to the question of whether it moves the market. So who is the market? So like we know now what the CFD is, right? Was that a kind of reasonably clear? So it's basically
Yeah,
party
yeah, yeah.
A betting against party B. Now, who's the market here? I mean, from
Party
the
B,
standpoint of
yes.
party A, the market is party B, the side who took the other side of his trade. That's the market.
Yeah.
Okay. Now, in this particular case, I refer to two words: a broker or a dealer, and they
Hmm.
have specific meanings. So,
Yeah.
a broker is an intermediary who does not take proprietary risk. So, in this case, for instance, let's say the flow of information was party A has placed a trade, a CFD with party B. And if party B is a broker, meaning he doesn't want to bet against Vodafone, he would say he would take a commission for brokering a transaction between party A
Hmm.
and say party D, which
Yep.
could be say a liquidity provider in this setup. So party A bets against party B that Vodafone is going to go up. Party B shuns the market risk, and then party B bets against party D in the same way that
Hmm.
party A bet against party B. And I know it's kind of a lot of mumbo jumbo, but that's that risk, market risk is getting transferred here.
Okay.
Okay, because party B in this case is a broker who does not take any risk.
Got it.
Now, if we go back to our Brokernomics series, and I might even eventually find the presentation. Where is the thing?
I
Yes,
think you
here.
had it open. Yeah, there it is.
I had it open. So if we look at the revenue for the different, like who's the market here? It's like it could be a broker. So in this setup, what I've done is I have fully hedged Ali's bet against a third party. I have charged Ali a commission for it, and I will probably have paid my prime broker a commission for hedging the trade. And what remains net of that is this revenue at the bottom.
Okay.
Because I fully hedged the thing. That's the broker business model. Now, let's look at the other example, which would be a pure dealer. A pure dealer would be a gambling house. That's as simple as that. So Ali has bet that the Vodafone stock will go up, and the house takes the other side of the trade. And then at the end of it, whatever money is made or lost is a zero-sum game between Ali and the house.
Got it.
Okay. Now, as we both know, the CFD industry, there's the one word which is kind of the true word is contract for differences. Another byword for CFDs in the industry jargon is cash for dealers.
Cash for dealers.
Right? Cash for dealers.
That's
now,
a good one.
Why is that? Does that happen? We can talk about this, and we should do like an episode on this one.
Yeah, just cash for dealers.
There's a psychological bias called loss aversion, which we'll explain elsewhere, which makes sure that when somebody is levered over and above what his gut can take, then he is systematically going to cut his winners short and let his losers run, which is the safest way to losing your shirts, which is cash for the dealer at the other end of the spectrum. Okay, so coming back to the business model implications of this, and again, I will find this, hopefully. This is the other curve, which is client commission spread and financing, which is another way of saying all the money that leaves the client's account and ends up in the dealer's account. So if, and again, this is not bad-mouthing IG or anything. So this is about, displaying public information that they have done a great job at doing. So if IG had taken the other side of all the trades by clients and not hedged anything out to the market, this is the upper curve is the dealer's revenue curve.
Financing.
Yeah, so this is what the dealer would have made, which is essentially the flip side of what the customer would have lost. Okay, so that's the other extreme. And the last model is the hybrid model, which is the broker-dealer model, where depending on the risk that the counterparty, like that the dealer incurs, he may choose to hedge out some of it in some circumstances so that he makes more than the broker, but less than the pure dealer. But also he needs to have a lot less capital. So this is probably the optimum in terms of the requirements of shareholder capital and risk that they're taking versus the revenue they capture by being the counterparty to the players. Basically, we've covered the first part, which was what a CFD is. Now we've covered the second part, namely what the market is. So in this case, the market could have been party B or any downstream, like risk downstream parties who are willing to take the other side of Ali's Vodafone bet. That's who the market would be in a bilateral setup. Okay. Now, whilst we have the chart here, this is an over-the-counter market, and this is how CFDs, this is the way FX and CFDs is traded. The way futures or cash equities were traded, at least when they are traded on an exchange, is a different setup, in my opinion, a superior setup, one where there is a construct that's called the central counterparty, that is the middleman to any transactions between any of the parties. Now, the important thing about this one is that all the liquidity meets in a single order book. We can talk about that some other day at the same time. So you know exactly how much interest there is at the other end of your long Vodafone trade. Okay. And that brings us to the crux of the question, which is, do CFDs move the market? And the answer is, it depends. Right. What does it depend on? Well, it depends on, for one, the size of Ali's trade. If Ali's trade is minuscule, then party B will most likely internalize this, act as a dealer, take the other side and fill him at the spread. Okay. The market price for Vodafone will probably be the market price that's here on the, I guess, Vodafone is listed at the London Stock Exchange, I presume. So there will be people trading on exchange Vodafone, and the central counterparty, which is the exchange, streams a price that informs party B, who then offers that price with that spread to party A. And what happens is that party B, de facto, and this is literally what's going on, free rides on the public price that came out of the public the price finding mechanism.
Yeah.
This is why exchanges are now very, very adamant that CFD liquidity makers, market makers, pay top dollar for the price feed that comes out of the public price finding mechanism.
Right.
Okay. So to come back to the thing, if Ali's trade is very small, then it will not move the market because it will never even hit the market. It will stay here. It's just become a bet between two guys who basically cross bets outside of the Real Madrid stadium without actually ever entering the play.
Entering the realm. Okay.
Okay. So that's step one. Now, what happens if Ali were to be humongous? So that could happen in any of two ways. One is Ali being a large player by himself, or Ali being part of a stampede of traders who all of a sudden now want to buy Vodafone at the same time. Okay, so that's really the two ways. It's Ali. It's either a very super large Ali or 100,000 Alis at the same time.
In the Darwinex context, it could be a highly capitalized Darwin trading Vodafone, taking all its investors.
And this is a question of degrees. So then at that point, then this flow of risk would hit party B, and then party B would probably take on a bit of it, but then the rest it would pass on to party D, and so on and so forth. And at some point, that interest would eventually find its way to the central counterparties so that it would actually move the price.
Right. Okay.
So the question is, does this thing move the thing or not? Well, in most cases, Ali is kind of pushing this dam from the other side. Nothing ever happens because the flow of Ali's risk is not enough to actually kind of move the needle here.
Yeah.
But at times where there are stampedes, and this is like the flash crash situation and so on. And sorry, I hope my Mac will eventually, I have no idea how to use this thing anymore. Yeah, there we go. So at some point, if enough people want to buy Vodafone, then all the dams will be overflown and the whole thing just flows downstream. And at some point, you don't know how tall the dam is, which is the kind of seller interest in Vodafone, until you overflow it, by which one afterwards is a free fall.
Lots of spillage in this case, which would be slippage.
Lots of slippage. I mean, this is basically a flash crash scenario. Yeah. So the answer, I guess, do CFDs move the market? And the answer is they don't until they do. I guess that's the answer, and hopefully I've explained the chain of middlemen that are part of this risk transfer curve, which is the water in this analogy that I just did.
No, thanks for that. I think bilateral versus central counterparty isn't something that's even talked about by practically any participant, at least people making markets or other brokers. So it's important that this content.
Okay, so I guess we can do a video right on that.
Yeah, I mean, why isn't this talked about is another theme in itself. So yeah, let's do that. But thanks. This was great. Thank you.